All right, Bulls and Bears, welcome back to another dose of economic reality. It is Wednesday, September 4th, 2024. A lot of things to get into economically, financially, and everything in between. Let's start with the U.S. consumer losing steam very, very quickly. And there's a lot of different things that we look at that people spend money on, but some of it is frivolous spending. It's stuff that people want, but they don't really need. And that is entertainment. And cable TV is a big gauge for, I think, the state of the U.S. consumer and the resilience of the U.S. consumer. We're told that the consumer is resilient, but we know that it's mostly based on availability of credit and borrowed money and credit cards, which is technically borrowed money, to maintain their lifestyle, to maintain their purchasing habits. Well, there's an area that we like to look at, and that's cable TV. Business Insider put it like this: cable TV's collapse deepens. It's becoming increasingly clear that there's no longer any floor. Now, we saw this in the first quarter with a massive amount of people cutting cable, including a lot of these subscription services. Now, Netflix is the outlier. Netflix is remaining very, very strong, but the pay TV industry lost 1.6 million subscribers in the second quarter of this year. Now, it's not a record. It was actually more people cut the cable in the first quarter of 2023 versus now. But it gets to a point where there's not many people left to cut the cable. And, you would expect the numbers to get worse, but, when there's less people left with cable to cut the cable, it's harder to get that big number again, though. But pay TV distributors, conventional cable like Comcast, and even satellite TV outfits like DirecTV and digital alternatives like YouTube TV lost 1.6 million subscribers. Now, that's all these different paid types of TV programming that people pay for. That was in the second quarter. But that's not bad, as in 2023's actually second quarter, when the industry lost 1.7 million. So almost as bad. Almost as bad. So this is another sign, folks, that the consumer, if they're not tapped out, they're getting close to being tapped out, and they're growing very concerned about what they're spending their money on. Now, those 1.6 million subscribers lost in the second quarter account for nearly 7% of the industry's entire customer base. Analysts Craig Moffett and Michael Nathanson wrote, quote, "It's becoming increasingly clear that there's no longer any floor. It was thought of a few years ago that digital pay TV programs like YouTube TV and Hulu would replace the losses at conventional cable distributors, but that's no longer the rule." So we're seeing people cut the cable and cutting these streaming apps in many cases. Not all of them, but a lot of them. But overall, it's a net loss. And folks, the turmoil continues. Take a look at this. Dish and Sling TV lost 104,000 TV customers in the second quarter of 2024. So it's widespread. Satellite, cable, these streaming apps that want you to pay so much per month to get their programming. Dish Network, a leading satellite TV provider, announced a net loss of 104,000 paid TV subscribers in the second quarter. The same quarter last year, though, they lost 294,000. So it's kind of like inflation. Is it getting better? No. Is it getting less bad? You can make that argument. The company attributed the slower decline to subscriber additions to its Sling TV streaming service and a reduced churn rate for its traditional Dish TV satellite service. Now let's take a look over at one of the biggest cable TV provider companies there, Comcast. Comcast, ticker symbol CMCSA, $39.50. But this is a one-year chart, folks, and we see that the peak was January of this year, just under $47. So from $47 down to under $40. Not looking so good, especially for someone that bought at the peak. Let's see here. They do give you a yield, though, of 3%. So you're getting 3% just for holding the stock. But hopefully you didn't buy at the peak. Let's go out to a 5-year chart. Kind of treading water. If it weren't for the dividend, I'm not sure a lot of people would be continuing to hold this stock here, really going nowhere over the past few years, up and down. Now, let's take a bit of a step back out of the United States and head on down to the land down under, Australia. The Australian economy is stuck in slow lane as household spending drags. So what Australia did is they did a round of rate cuts starting July 1st of this year. Not rate cuts, rather, but tax cuts. They reduced 19% tax rate down to 16%, and they reduced the 32.5% tax rate to 30%, increased the threshold above which the 37% tax rate applies from 120 to 135,000. With all those things being done, even that couldn't kickstart the consumer spending in Australia. And why do you think that is? Well, it's similar to here in the US. It's a cost of living problem. It's a price level problem. They're not allowing prices to correct, just like the United States. We're keeping all these bubbles inflated. We're keeping prices propped up. We're afraid of deflation because deflation would actually cause negative growth to appear based on the gauge of what growth is looked at or what it's compared to, and that's GDP. So they can't allow deflation because that would show a negative growth print. And nobody wants that because that's the official definition of recession when you have two negative quarters, or two consecutive quarters rather, of negative growth. So they can't allow deflation because that rips the mask, rips the veil off of this illusion of a growing economy. So same thing's happening in Australia. They have to keep the cost of living high, keep the bubbles inflated. They don't want to allow deflation. It's more debt piled on top of more debt and continually rising asset prices. Otherwise, the economy looks like it's not growing to the untrained eye, that is. But not to my viewers, myself and you. I mean, we know the game and the scheme that comes along with making the economy look like it's growing, right? And PBS put it like this: the Fed celebrates the end of inflation surge, but many Americans don't feel like cheering. Fed celebrates the end of inflation surge, but many Americans don't feel like cheering. Exactly, right? People can tell just based on their own experience and their own situation what's really happening with the economy. I mean, one person's bad economy is another person's good economy. Most Americans are not in the same celebratory mood about the plummeting of inflation. It's really not plummeting, it's slowed, but they call it plummeting. In the face of high borrowing rates that the Fed engineered, though consumer sentiment is slowly rising, a majority of Americans in some surveys still complain about elevated pricing. So if the majority of Americans are complaining, how is the consumer confidence survey rising? It really doesn't make any sense. I don't know if I believe these confidence surveys. I don't believe the polls. I don't believe a lot of the data that comes out. Just connect a few dots, folks, and we can see, what's really happening here. All right, let's switch it up a little bit here. Let's go over to fast food prices. We're going to talk about McDonald's. Controversy. People are outraged. Are McDonald's prices higher on the app than in person? An investigation in New York City. And we see some people putting posts out on social media, and they are pissed. I want an investigation. Why are you charging more for my fries on the app versus just going to the counter? Why? I want to know. So, folks, these are first world problems. Here's what you do. If you look at the price on the app, then you go into McDonald's and it's cheaper on the menu, order it from the menu and not on the app. That's what I would do. But people are making social media posts about it, like this guy right here. He's mad. He's upset, folks. Again, first world problems. What do you think about that? Something to be outraged about? How's about don't use the app? Pretty simple, right? Let's talk about what's happening with credit cards. Obviously, something to keep an eye on is the delinquency rate on credit cards. That'll give you a pretty good gauge on U.S. consumers. We also see rents dropping. That's another big indicator of how well off, or not well off, rather, the U.S. consumer is. Well, let's head into a one-year chart here on the U.S. credit card delinquency rate. Well, better yet, let's zoom out to 5 years here. Let's go ahead and bring this up here because this will go right into 2020. And we saw throughout 2019, the delinquency rate was in the mid 2% range. Of course, it dropped in 2020 with all the freezes, the moratoriums. You can't be evicted from your apartment, all the rescue programs such as that. It dropped to 1.5%. But look where we're at now. We're worse than where we were going into 2020. So the trillions of dollars that were created, all the rescue programs, everything that went along with what caused all this inflation, did it help? Would it have been less? Would it have been worse without those programs? Because now, for the most part, it's worse now than what it was going into 2020. We're now at about 3.25% delinquency rate. And that's at the end of the second quarter. As of the end of the second quarter, of course, the third quarter numbers aren't out yet because we still have to go to the end of September before those numbers are out. But we're going to get those numbers for you as soon as they're out. And, of course, we're going to report on that for you. So make sure that you are subscribed so you keep updated on all this information, folks. I think it's going to go up again. The delinquency rate, 3.25. I'm guessing it's probably going to go to 3.4, 3.5, or maybe even worse. If it's worse than that, that's really going to be a red flag. And again, we have Red October right around the corner. Many things happening in the month of October, things to keep an eye on, not just the black swans, but the things that we know are going to be implemented. We know that there's a big BRICS meeting in October. We know that there's new bank capital rules being implemented October 1st. Some people say that's a big deal. Other people say not so much, because even if the banks, quote unquote, fail or can't meet the capital requirements, they're just going to get a big liquidity injection of billions, who knows, maybe even trillions of dollars. Why? Because they're too big to fail. You cannot let the banking system fail, folks. Otherwise, the whole economy comes down with it. Why? Because the economic illusion relies on people's ability to borrow more and more money and to go further and further into debt. All right, folks, let's jump over to another economic indicator, and that is rents. And what do we look at? One of the things we look at, besides the actual cost of rent, we know that rents are actually down year over year, which is a sign by itself. But we also look at the vacancy rate, right? And even with tens of millions of people pouring into the land here, we still have a vacancy rate that's climbing. And let's again go back about 5 years here to the beginning of 2019. We saw at the peak before now, 6.8%. That was the peak. July 2020, the vacancy rate was 6.8%. And of course, we know what happened. A big drop with everything that happened, the eviction moratoriums, etc. But now we're back up here as of August to 6.7, just about where we were in July 2020. So another example of trillions of dollars, Inflation Reduction Act, all these rescue programs again. Did it end up helping people? Well, no, it looks like the vacancy rate is going to be ticking past where it was in July 2020. And what are vacancies a sign of? It's a sign of a consumer that can no longer meet their rental obligations. So therefore, they have to vacate the apartment or the premises, whichever one it is. Could be a single family home. This is vacancy rate index out of apartment list. And here's how they broke it down. The rapid price fluctuations that have defined the rental market over the past 3 years have largely attributed to changes in the balance between the number of vacant apartments available, supply, and the number of renters looking to move into them, demand. Early in the pandemic, apartment list vacancy rate rose to 6.8%, like we just talked about, as many Americans consolidated households and moved in with family amid large job losses and economic uncertainty. Then a suddenly tight rental market drove rapid rent growth in 2021, 2022, as more households competed for a dwindling supply of vacant units. Our vacancy index tightened from 6.8% to 3.8% in just over a year. So here we are back to where we were back then. So this is another sign. To me, it looks like another sign that a lot of people are choosing not to rent their own apartment, and more people moving back in with parents, who knows, relatives, mom and dad, grandma, grandpa, you name it. And we have a mix of price increases and decreases year over year. Here's some of the decreases. The decreases are actually bigger than a lot of the increases. Austin, Texas, down 7.5% year over year. Raleigh, North Carolina, down 4.8%. Jacksonville, Florida, down 4.4%. Atlanta, Georgia, down 4.2%. Charlotte, North Carolina, down 3.4%. To wrap up the top five. Biggest declines. The biggest increases year over year, we've got Cleveland, Ohio, up 5.9%. Louisville, Kentucky, 4.5%. Hartford, Connecticut, up 4.4%. Virginia Beach, 4%. And Tulsa, Oklahoma, up 4% year over year. I guess I'll throw in number 6 from my home state of Michigan. It's Grand Rapids, up 3.8% year over year. So it's a local, it's a mix. Not anything happening as far as a bust when you look at the nation as a whole, but there are pockets of weakness and pockets of positive rent growth still, right? So we're not seeing this this bust in the housing market and the rental market with home prices. It's a continued slow churn and push into higher inflation is what it looks like to me, because the banks are still being propped up. They're still able to loan out money. October right around the corner, folks. So brace for it. Am I guaranteeing something's going to happen? No, but I've got a very, very strong feeling. And if you've watched my videos, you know I usually don't put timelines on these things like I am this time. Right? I do feel by the end of October we're going to see something significant pop off, for lack of a better term. If you've watched my videos over the past few years, I've always been one to say inflation could keep going. They could keep kicking the can down the road. They can keep finding or continue to find new ways to prop this thing up. All right. And I continue to say that it's going to have to be something major, something big time disruptive to halt what's happening right now with the price growth, the cost levels, the price levels, this inflation. It's going to have to be a complete shutdown or shock type of news that comes out. What type of shock news can you think of? I can think of a lot of things that are going to be revealed, put into light, so to speak, uncovered or unveiled, so to speak. A lot of things that we talk about here in this channel, if people really knew the source of economic growth, for example, and how the banks are going to be propped up here, or inflation is the illusion of economic growth, and how they would rather have you go deeper in debt than to admit that the economy's not strong, right? All these things. And then people wonder why, they're working 2 jobs, 3 jobs, both spouses are working. People can't afford to have kids anymore. Some can, some can't. But if you look at the child birth rate, that's plunging. People are afraid to start a family because of the cost of living, right? All these things. And now we see these other reports here today. People cutting cable, cutting out a lot of these programs, discretionary spending. What do you guys think about all this? Please let me know down in comments. Make sure you are subscribed. Keep stacking. Get yourself some real money, because we're going back to sound money very, very soon. I'd say within 2 to 3 years. So keep stacking that silver, folks. Price pullbacks are buying opportunities, in my opinion. That's what I'm doing. Not giving any investment advice. We did well, though, on NVIDIA and Rivian stocks. Didn't we see those drops here recently? Very nice on betting against those stocks. And I'll let you know what I come up with as far as new investments, new ways to try to take advantage of this mania, insanity in the markets, in the economy, in the financial system, etc. Right? Everybody keep stacking. Bye for now. Peace.